A warm welcome to all of you joining us today. Thank you so much for coming to watch this video. We know your time is really valuable, and we are just thrilled you've chosen to spend it with us.
Yeah, absolutely. Thanks for tuning in, everyone.
So today, our mission is incredibly clear. We are summarizing the prepared presentation from TDK Corporation's third quarter financial results briefing. Specifically, we're looking at their fiscal year ending in March 2026.
Right.
And, if you follow the tech hardware space at all, or even if you just track global macroeconomic trends, corporate earnings reports at this scale are, well, they're treasure troves of information. We're going to extract the most critical nuggets of insight from this presentation, filter out all the noise, and bring you exactly what you need to know about TDK's current market position and, frankly, their outsized bets on the future.
It is great to be here and to be speaking with all of you watching. I actually think it's absolutely crucial to set the overarching theme for you right out of the gate here.
Yeah, set the stage for us.
Right. Because when you hear the name TDK, you might initially just think of them as a standard components manufacturer. Maybe you remember blank cassette tapes from back in the day.
Oh, definitely.
But to view them simply as a factory outputting parts is to really miss the broader systemic story. TDK's financial results act as a perfect, real-time thermometer for the entire global tech economy.
A thermometer. I like that.
Exactly.
Yeah.
Because they supply fundamental components across multiple sectors. I mean, from automotive to smartphones, from massive data centers to industrial equipment. So their balance sheet shows us, with pretty much mathematical precision, exactly what industries are booming and which ones are actively stalling out.
Okay, let's unpack this because the numbers we're looking at for the first 9 months of this fiscal year, so that's April to December, they are substantial.
Huge.
We are talking about record headline numbers here. TDK reported net sales of 1,858.6 billion yen.
Yeah, that is an 11.3% increase year over year. And it's not just top-line revenue that looks good, right? Their operating profit hit 230.7 billion yen, which is a 10.4% increase.
Mm-hmm.
We're looking at record highs for net sales and profit at every single level for this 9-month period.
Yeah, it's massive.
When you see double-digit growth percentages for a multinational of this scale, it immediately warrants a closer look at the underlying mechanics.
What's fascinating here is the story hiding just beneath those top-line numbers, because it's a story of highly contrasting macroeconomic forces.
How so?
Well, when we look at where this growth originates, it paints a really vivid picture of the current economic landscape. On one hand, you have ICT and data center demand. This sector is experiencing profound systemic growth, specifically the demand for nearline HDDs.
The hard disk drives?
Right, the hard disk drives, which are the absolute backbone of cloud storage architectures. That demand has stayed incredibly robust. But on the exact opposite side of the spectrum, the automotive market is acting as a heavy anchor right now.
Dragging them down. It's exactly. Battery EV demand remains notably weak, and overall automotive parts demand actually fell below TDK's initial internal forecasts. So you have this intense dichotomy. The digital infrastructure and cloud computing build-out is pulling the numbers way up, while the sluggish EV transition is heavily dragging them down.
Right, and it's not just a clean split between those two industries either. We also have to factor in the FX impact, the foreign exchange, which is just a major variable in these quarterly reports.
No, massive.
TDK reported that FX created a 29.4 billion yen tailwind to their net sales. But simultaneously, this exact same currency environment acted as a 9.3 billion yen headwind to their operating profit.
Yeah, it's a classic double-edged sword.
Exactly. You get the paper boost on the balance sheet when you repatriate those foreign revenues back into a weak yen, but your operational costs are just eating you alive on the factory floor.
Precisely. It perfectly illustrates why we can't just look at the raw revenue numbers and move on. A weak yen inflates the reported value of overseas sales, sure, but TDK's global manufacturing footprint means they are purchasing raw materials and paying operational costs in foreign currencies.
Largely U.S. dollars, right?
Largely U.S. dollars, yes. When the yen weakens, those dollar-denominated production costs spike significantly. TDK's own sensitivity analysis indicates that a single yen move against the U.S. dollar impacts their annual operating profit by 2 billion yen.
2 billion yen for a single yen move. That's wild.
It is a profound swing based purely on macroeconomic currency trading. It's entirely separate from their actual manufacturing efficiency or product demand.
Here's where it gets really interesting. Let's look at the breakout stars of this earnings report. Because despite that automotive drag and the currency friction we just talked about, Two specific segments within TDK experienced exponential growth.
And we really do mean exponential here.
Right. Sensor application products saw their operating profit go up by about 3.5 times year over year, hitting 19.2 billion yen. And then magnetic application products saw operating profit go up nearly 5 times, reaching 19.4 billion yen.
To understand those multipliers, we really have to look at the underlying engineering. In the sensor segment, a significant driver was MEMS sensors crossing back into profitability.
Which are the microelectromechanical system.
Yes, we saw microphone sales for the ICT market increase, alongside motion sensors for industrial equipment. But the real technological standout here is their TMR sensors.
The tunnel magnetoresistance one?
That's the one. TMR technology relies on quantum mechanical tunneling to offer extreme magnetic sensitivity, but with incredibly low power consumption. They are becoming completely indispensable in high-end smartphones.
For what specifically?
Particularly for optical image stabilization and precise autofocus in those modern multi-lens camera arrays you see on the back of premium phones.
Okay. That makes sense.
So you have legacy MEMS products leaning out and becoming profitable, combined with surging demand for these advanced quantum-level sensors in premium mobile devices.
And it makes total sense that premium smartphones are driving that volume. But when we pivot over to magnetic applications segment, the volume increases are just as striking, but for very different reasons.
Very different.
HDD head sales volume increased by 15%, and HDD suspensions, which are the delicate mechanical arms holding those heads, those saw a volume increase of over 30%. You mentioned earlier that nearline HDDs are driving this.
Right.
But I have to ask, why are we seeing such a massive spike in physical spinning disks? I mean, shouldn't the AI boom be entirely reliant on ultra-fast solid-state flash storage?
If we connect this to the bigger picture, you are touching on the fundamental architecture of modern AI data centers. Yes, AI training requires high bandwidth memory and extremely fast NVMe SSDs to feed data into the GPUs without bottlenecking the compute layer. That is true. But the sheer volume of data required to train these large language models, the exabytes of scraped text, video, and audio, it's unprecedented.
So it's just too much stuff to put on flash.
Storing that much data on flash storage is economically unviable. Nearline HDDs offer a cost per terabyte that SSDs simply cannot touch right now.
So it's essentially an economics play at scale. The SSDs handle the immediate processing cache, but the vast data lakes themselves, they reside on high-capacity spinning disks.
Exactly. And the engineering inside those high-capacity drives is just staggering. To increase storage density, manufacturers are stacking 10 or more platters inside a completely sealed, helium-filled enclosure.
Helium-filled?
Yeah, to reduce friction. And TDK supplies the micro-actuators and suspensions that position a read-write head nanometers above a platter that's spinning at 7,200 RPM with pinpoint accuracy.
That is insane precision.
It is. So when you see a 30% jump in HDD suspensions, you are literally watching the physical plumbing of the AI revolution being deployed. They are providing the mechanical precision that makes the cloud's economics actually work.
It's wild how profitable the digital realm is for them right now, but TDK is still heavily anchored in the physical world, particularly in how we power all these devices. Let's look at their heavyweight division, the energy application products.
This is the big one.
Yeah. This segment alone brought in over 1 trillion yen in net sales for the 9-month period. That is up 14.4% year over year. The core drivers are their rechargeable batteries, so small capacity ones for smartphones and medium capacity ones for industrial applications. On paper, crossing the trillion yen mark looks like an absolute triumph.
It is a significant milestone, no doubt. Yeah. But we need to inject some crucial nuance here. While the 9-month trajectory is upward, if you isolate the third quarter, so that's October through December, and compare it to the second quarter, the operating profit for this energy segment actually dropped by 18.1%.
Wow, almost 20% drop sequentially.
That is a sharp sequential decline. And TDK was very transparent about the mechanics causing this. They are fighting the structural impacts of elevated material price increases.
Like raw materials.
Yes, the spot pricing for lithium, nickel, and cobalt has been notoriously volatile. And there's often a lag before component manufacturers can pass those costs down to the consumer electronics OEMs.
Right, they have to absorb it in the meantime.
Exactly. Additionally, they experience seasonal volume dips in smartphone battery demand and reduced orders for EV power supplies.
So despite moving an immense volume of batteries for consumer electronics, the margin compression is severe. the cost of goods sold is just eating into the corporate profit. It really highlights for you that high revenue does not automatically translate to high profitability when your supply chain relies on volatile raw commodities.
Precisely. And that exact tension brings us to what we can call the mixed bag of this earnings report.
A passive components segment.
Yes. This segment perfectly illustrates the complexities of the current hardware cycle. For the 9-month period, net sales for passive components were up 3.2%, reaching 438.2 billion yen. However, the operating profit for this segment plunged by 25.6%.
Sales go up over 3%, but profits fall by a quarter. That points directly to a loss of pricing power, doesn't it? If they're pushing more volume out the door but taking a 25% haircut on the profit, the average selling prices must be dropping.
This raises an important question, a really critical one, about product mix and sector-specific demand. Let's break down the actual components here. Take ceramic capacitors.
Okay.
TDK achieved higher sales volumes here, largely driven by automotive and industrial equipment channels. But the profit declined because the average selling prices dropped. They had a discount.
Why discount if volume is up?
We're likely seeing the effects of inventory digestion at Tier 1 automotive suppliers. When the EV market slows down, the supply chain backs up, and component manufacturers often have to lower prices just to keep the factory lines running and clear out that inventory.
But not all capacitors are taking a hit. I see here that aluminum, electrolytic, and film capacitors are actually thriving.
They are, and the divergence is very telling. The growth in aluminum and film capacitors is being driven by renewable energy applications and, crucially, AI servers.
Right, back to AI.
Always back to AI. Standard enterprise servers might draw, say, 300 to 500 watts of power. A modern AI server rack can draw tens of thousands of watts.
That's a massive leap.
It is. That requires entirely different high-end capacitors to handle the thermal loads and the ripple currents. So TDK is seeing fantastic margins there. But all of that specialized success was severely offset by the sluggishness in the broader automotive and EV markets we discussed earlier.
It just wipes out the gains.
Pretty much.
Yeah.
Furthermore, in their inductive devices, they had higher sales, but profit fell due to an unfavorable product mix.
Which essentially means they are selling a higher ratio of commodity, lower margin inductors, and fewer of their highly specialized high margin variants. Even with the AI server market pulling its weight, the sheer volume hole left by a stalling EV market creates a systemic drag on the entire passive component segment's profitability.
That is exactly right. It highlights how vulnerable even a highly diversified global manufacturer can be to sector-specific slowdowns. They are positioned well technologically, but they cannot entirely escape the gravity of global automotive trends.
So what does this all mean? We have looked at the profound growth in sensors and HDD parts, the margin struggles in batteries, and the deeply mixed results in passive components. Where does TDK go from here?
Well, their outlook is fascinating.
Right, looking at the strategic outlook, they are projecting serious confidence. They've actually revised their full-year forecast upward. They are now projecting 2.47 trillion yen in net sales and 265 billion yen in operating profit for the full year.
And they put their money where their mouth is, too.
They did. To back up that confidence, they're increasing their annual dividend forecast to 34 yen per share, which is up from 32.
The dividend increase is a strong signal to shareholders, absolutely.
Right.
But I think the most crucial strategic move revealed in this presentation is their capital allocation strategy.
The reinvestment.
Yes. TDK announced they are increasing their capital expenditures. So CapEx is going up by 20 billion yen to a total of 300 billion yen for the year. Simultaneously, they are increasing their research and development expenses, also up 20 billion yen, bringing the R&D total to 280 billion yen. They are aggressively reinvesting their current cash flow back into the business.
I need to push back on where exactly that 500 billion yen in CapEx and R&D is going, though.
Okay, let's hear it.
Because we just discussed how their third quarter profit margins in the energy segment got severely squeezed by raw material costs. And we talked about how the EV slowdown is this massive anchor on their passive components. Yet TDK is heavily directing this increased spending into the development of new technologies and products in the rechargeable battery space.
Yeah.
If EVs are dragging them down right now, why double down? Why not pivot that capital entirely into the booming AI sensor or data center sectors?
It is a totally valid question. And it really speaks to the difference between quarterly reactive management and long-term strategic positioning.
So they're playing the long game.
Very much so.
Yeah.
TDK recognizes that while EV adoption might be experiencing a temporary plateau right now, The long-term secular trend toward electrification is inevitable. Furthermore, battery tech isn't just about cars.
What else is driving it?
Edge AI. As Edge AI becomes more prevalent, meaning running complex AI models locally on your smartphone, on wearables, and in industrial robotics, the power draw on those localized devices will increase dramatically.
Ah, so they are betting that the energy density requirements across all consumer and industrial electronics are going to hit a wall with our current lithium-ion technology.
Precisely. They are funding the transition to next-generation materials, whether that involves high silicon anodes, advancements in solid-state technology, or just more efficient manufacturing processes to insulate themselves from that commodity volatility we talked about.
So they're buying their way out of the margin squeeze through innovation.
By accelerating their R&D in battery technology now, yes, they are aiming to innovate their way out of it. They are utilizing the outsized profits they are generating today from the AI and data center boom to ensure they own the foundational battery IP of tomorrow. It is a highly calculated play for dominance in their next medium-term plan.
It is a remarkable balancing act of global proportions when you step back and look at it. Watching a company navigate raw material costs, shift capital away from stagnant sectors, absorb intense currency fluctuations, and still post record profits while heavily funding their own long-term roadmap.
It really provides a masterclass in reading the macroeconomic tea leaves.
It really does.
So to provide a high-level wrap-up of what we have analyzed today,
Please do.
the main themes from TDK's third quarter presentation are clear. First, PDK is aggressively riding the wave of global AI and data center infrastructure investment. Their HDD components and AI server capacitors are acting as the physical building blocks of the cloud, and that's driving substantial profits.
Yeah.
Second, they are experiencing tangible headwinds from a sluggish automotive and EV market, alongside systemic raw material cost pressures that are compressing margins in their energy segment.
The anchor we talked about.
Right. But third, they are strategically utilizing the cash generated by their current digital infrastructure successes, and they're investing it directly into next-generation rechargeable battery tech, positioning themselves for when the EV and industrial markets ultimately rebound.
It paints a really comprehensive picture of where the tech hardware industry currently stands.
It does. And I want to leave you, the viewer, with a final provocative thought to consider.
I love these.
We have discussed the AI data center boom and TDK's investments in battery technology as two largely separate pillars of their business today. But as AI models grow exponentially more complex, the data centers training them are going to require unprecedented amounts of power.
The grid is already feeling it.
Exactly. We're already seeing the energy grid feeling the strain, prompting tech giants to look into localized power generation and massive on-site energy storage. So consider this. How will TDK's unique dual dominance in both data storage hardware and advanced energy application products position them for a future where data processing and power management are no longer separate industries, but deeply intertwined?
That's a huge shift.
In a world where the convergence of data and power is the ultimate bottleneck, TDK's current R&D strategy might just place them at the very center of the global economy.
What a fantastic point to end on. Thank you to everyone watching this video. We really appreciate you spending your time with us to analyze this report. If you found this breakdown valuable, please click the like button, share this video with anyone else who loves tracking tech, markets, or global trends, and make sure you subscribe to the channel. Stay tuned because we have plenty of upcoming content planned for you. Until next time, keep analyzing, keep questioning, and keep learning.